And hello, Savannah. This is Julia M. Spencer. You have just tuned into Real Estate Real Talk on a Wednesday afternoon. It's Hump Day. Yay! Thank you for tuning in. You're actually listening to WRUULP, Savannah, Georgia, 107.5 FM, WRUU.org. We are Savannah Soundings Community Radio with Global Soul. And today I have a very special show here for you from downtown Savannah. I have a special guest here with me in the show. He's a senior loan officer, Chuck Feagin.
Feagin. It's okay.
Feagin. Okay, sorry. I said that wrong. And you actually have been on the radio before, so thank you.
Yeah, absolutely. Thanks for having me back. I've been on WRUU before and always like supporting community radio here in Savannah, and was excited to find out about your show and come on and talk a little bit about real estate finance. Very awesome, very awesome. And we have lots of questions, actually. So I sent you the questions last night. I hope you were able to look over them a little bit. Now, you are actually working with a local bank. I think it was Flagstar Bank you mentioned, and I have a loan with them. So I have good questions. Did you look me up? I did not look you up. No, I didn't look you up.
Make sure I made my payments on time this year. And this month anyways. And you're also actually plugged into the city and lots of boards and authorities. Why don't you just introduce yourself a little bit and talk about what you do?
Yeah, absolutely. Again, my name's Chuck Feagin. I've been in Savannah for almost 8 years now. I've been in the mortgage business for 7 of those years. And more importantly, I've just been kind of really involved in the community of Savannah and just kind of lending my talents and expertise into various roles that I can get a lot of feedback from the community on the future of this town. This is a really, really special city, and I think that we have a lot of tremendous growth opportunities over the next 10 to 20 years here, and that bodes well both just for the general real estate market, general real estate community, and just for the citizens as a whole of Savannah. So I look forward to having this great conversation, answering more of your questions over this hour here.
Yes, great. And so I was just going to jump right in, but before I go there, if you're listening today and you have more questions and your questions weren't answered, we're going to give you a little bit of information how to reach Chuck and myself as well. You can always reach me at realestate@juliamspencer.com. You can send me emails. I'm all over social media, so you can send me comments to my videos or pictures. I think that's how you reached me too as well.
That's right.
So, let's just get started. I'm just going to ask you questions and then kind of have a conversation and break it up a little bit halfway through. I always have to interject my little songs here and there for entertainment. And, so the first question I had was, and I actually had that on one of my YouTube channel videos, was what does a loan originator do?
That's a very great starting question. So the job title for most of us is MLO, or a mortgage loan originator. And as simple as it sounds, it's very self-descriptive. We are the origination point of a mortgage loan. And so there are 3 types of mortgage lenders in the country here. You have what are called banks or brokers and lenders. Okay, so a banker, a broker, and a lender could be 3 different guys, could be 3 different companies, and 3 different states, right? I'm what's called a retail forward-facing mortgage loan originator, so I work directly with the public here in Savannah and across the country, actually, because I am licensed in all 50 states and frequently do business around the country. My job, what I frequently describe my job to clients my job is to find the path of least resistance for you to close on your home. There are numerous loan programs out there, and even within each specific loan program, there's numerous paths to the closing table. And so my job is to bridge the gap between the consumers, the customers, the clients who want to buy a house, and bridge them to the right loan product, the right path on closing on that product. And that deals with tons of documentation, tons of guidelines that are constantly changing. And so my job is to kind of guide the customers on that path and keep everything moving in a timely order, as well as overall just keep communication with everybody that's involved in the process. Typically, your home transaction has a buyer, a seller, a listing agent, a selling agent, a closing attorney, an appraiser, a lot of things that have to come together to make it all work.
I like the statement that you said, the path of least resistance, because there's a lot of resistance, obviously, to get a loan. I mean,
Absolutely, and for good reason. A lot of people. It seems like so long ago. I was in college during 2008 and 2009, and we saw the biggest financial crisis probably since the Great Depression in 1929. Starting essentially with the mortgage meltdown. And that had a lot to do, it was really 30-30-30 split, a lot to do with consumers themselves, a lot to do with the aggressive and loose underwriting guidelines that were prevalent during much of the early 2000s. And then, a lot of good part on the fault of regulators and the government for not stepping in sooner to stop that crisis. So I think the modern lending market that we're at in 2018 is a direct result of a lot of the past 10 to 20 years of experience.
That's wow. That's a lot of information.
Mm-hmm.
So you're saying you've kind of witnessed the whole entire mortgage meltdown, or you kind of jumped into it at the time?
I was very fascinated. I was an economics minor. I was a political science and sociology major in college, and so I was towards the end of college during the crash. I got very interested in what really caused this economic meltdown, because when I got out of college, very few companies were hiring. A lot of people can relate to the intern crisis. It was for people my age group coming out. It was, you, for your first job, you need 5 years of experience, but you need to be able to take a starting level salary. So I was very interested in how it came to be that the financial crisis had spread beyond one particular sector, being the mortgage industry, and had not just infected all of financial services, but you had a real credit freeze in this country between 2008 and 2010. And I wanted to see both how we're going to get out of that, and more importantly, what we're going to do in the future to prevent things like this from happening again. And for me, just a young man coming out of college, the best way to figure that out was to just jump right in. My first 2 years in the business were spent in a call center mortgage company doing primarily refinances. This is right when rates had first dropped to near zero. And so my career since then has kind of winded a path to mirror what the market is doing. We're much more in a purchase market economy the last few years. As rates and home prices continue to rise, I don't think that trend will go anywhere but further solidify. So again, I am very much looking out for the consumer, very much looking out for the customer, and how I guide them through the path of buying a home and on the finance side of it.
So you actually started working in a call center. Is that what I heard you say?
Yeah.
So you weren't like physically in a bank. You were doing the online thing. That actually leads us to one of the questions that I had. One of my subscribers actually asked, is it better to go to a local bank to ask for a mortgage loan, like physically walk into a bank or to a lender, or is it better to call these online services online to get a mortgage?
So the answer to your question is yes to both,
okay.
Right? Yes and no probably is the answer. And what I mean by that is, for example, myself, I'm a retail forward-facing loan officer. I definitely want to have either in person or on the phone, an initial good 45-minute to an hour-long phone call to really discuss the needs and the wants of the consumer and what they're expecting, so we can have proper expectations. But I can't tell you how easy it is for me to tell them to go to my website and pop in an online application, because it's going to take them 5 to 7 minutes on an online application to fill out all of the core items needed to really make a good determination, whereas it would take an additional 30 minutes of conversation for me and you to go through all of those things. And also just in the world that we're in 2018, more and more of all consumer activity is happening in an online environment. I mean, you look at Amazon being one of the highest valuated companies in the world, their founder being the richest person in the world at the moment. More and more people are comfortable using their phone specifically, but using the internet in general to fulfill a mortgage application. So I guess what I'm hopeful for is not necessarily that it's a unilateral choice, one or the other. It's not a zero-sum game. I think what people are looking for is more implementation of technology in the lending process, but they still, at the end of the day, whether it's through an app or whether it's just a cell phone number, a hard line, people want to have an ability to connect with the mortgage professional to be able to ask those 5 or 10 key questions that are going to make them feel comfortable about what they're doing. And that's really what I feel like I'm there for. At the end of the day, when you sign for the mortgage, it's you that's going to make those payments. I tell my clients often, I'm going to sleep well at night, regardless of what happens after we close this mortgage. But I want you to be able to have the same comfort because you're the one who's going to be making those payments.
Good stuff. Good information. So that kind of leads me to my next question. Is it then, since it doesn't matter whether you apply for a loan online or go to a local lender, is it better to, what's the difference between credit unions and regular banks? Is there even a difference?
That's a really, really great question. So we're going to get a little bit into the weeds on some regulations here. One thing to remember, all banks are regulated by the Federal Reserve. All federally chartered banks are regulated by the Federal Reserve, which is this country's central bank. All credit unions are regulated separately by what's called the NCUA, it's the National Credit Union Association. So there's a lot of differences. Credit unions, for example, do not, by and large, participate in the FHA program, which is the directly endorsed first-time home buyers program in this country. So they're limited in some aspects that they don't participate in those programs. However, credit unions tend to be very good on specialty type lending. There's a lot of investment in opportunity in the short-term rental market, Airbnb, VRBO, and I've seen credit unions step in to fill a niche in that particular investment lending space that a lot of traditional banks and lenders don't necessarily want to do. A very good movie I would recommend a lot of consumers to watch is a movie came out a couple years ago. It's called The Big Short. It's got a stellar cast in it, Brad Pitt, several others, and it's really about a couple different groups of guys who saw the mortgage crisis coming before it happened, and you get a really good explanation. It's important to remember that 95% of mortgage paper, we would consider the paper behind the loans. This is millions upon millions and billions of dollars of mortgage loans are constantly traded around the world. So for most banks and lenders, we're looking to make loans that fit certain boxes that we can sell the balance of those loans to investors so we can, of course, keep lending. Credit unions, again, set up differently. Most all of credit unions are limited in geographic scale or limited to specific demographics of members. You think about your Navy Federal Credit Union, you have to be a member of the armed services or an immediate family member. Local credit unions here in Savannah and Chatham County often are limited geographically. So again, somebody from California is not going to be doing major business with a local credit union here in Savannah. So it's just different business models. But again, all kind of lenders and credit unions fit to serve a specific niche. And that's what we want to do, is have the box as open as possible to as many consumers so that we can get more transactions done.
Wow, that's an excellent explanation. Thank you so much so far. You are listening to WRUU-LP, Savannah, Georgia, 107.5 FM, WRUU.org. We are Savannah Soundings Community Radio with Global Soul. And you're listening to Real Estate Real Talk with myself, Julia M. Spencer, with my guest here, Chuck Feagin. Okay. So I'm going to take a little bit of break here, and we're going to be back in just a few minutes. Hopefully I can figure out the board here again today. Have some computer trouble, and we will be right back. No, we are actually already right back because it's not working. Hold on. All right. Here we go. Nope. Okay. Well, in the meantime, let me just tell you a little bit about the Chatham Savannah Citizen Advocacy hosts the Oysters on the Bluff on Saturday, January 29th from 3 p.m. to 6 p.m. at the Isle of Hope Marina at 50 West Bluff Drive in Savannah. The event benefits a 36-year-old community-based nonprofit organization that recruits, matches, and offers support to over 110 local citizens and voluntary citizen advocacy relationships. For more information, www.savannahcitizensadvocacy.org, or you can call 912-236-5798. And you are listening to Real Estate Real Talk with Julia M. Spencer. And while I figure out my break music here, let's ask one more question.
Sure.
So we're kind of like winging it today because we are one computer short. It actually brought me to my next question when we're talking about credit unions and banks, which is, you mentioned it a little bit, FHA loans, VA loans, and we're getting into Freddie Mac and Fannie Mae,
Okay, yeah.
all of that. It's to a lot of people, our listeners that have never bought a house before, haven't gotten a loan before, all these terms are going way over their head. And
There are a lot of, if any of our listeners ever been in the military, ever worked in a medical environment, like all of those, we have a ton of abbreviations, whether it's DTI, LTV, FHA, Freddie Mac, Fannie Mae. All of these represent some aspect of the modern lending world that we're in. So we'll talk a little bit about, just for your consumers, your first-time buyers, your people who are buying a home to be able to live in as their primary occupancy, right? There are several loan programs available to them. VA stands for the Veterans Administration. These are limited to active duty and retired veterans of all 5 branches of the U.S. military. And these are, again, specific to those people who qualify under being a member of those branches of military. For most home buyers, they're looking at FHA and conventional loans. FHA, again, being the directly endorsed federal government program. It's a 3.5% down payment requirement, and has the most lenient credit underwriting standards amongst any loan program. Now, there's always a trade-off. FHA programs tend to require the asset, the property itself, being in relatively good condition. All the appliances need to be in working order. The power and water utilities need to be turned on at the time of inspection. Conventional home programs are more traditionally what people have thought as your 20% down, your relatively safe and highest qualified borrowers. That's not necessarily what is the case anymore with conventional. As part of the downturn in 2008, 2009, the federal government did take over fully what's called a receivership of Fannie Mae and Freddie Mac. These are previously privately held companies. Fannie Mae, as a matter of fact, was considered by many to be one of the greatest companies of the last 20 or 30 years, before the crash. But these companies set guidelines and policies for the lending environment nationwide. And so Fannie Mae and Freddie Mac are the 2 different companies that what are called securitized conventional loans. And so we follow their guidelines to a T for the most part. Really important to remember, Fannie Mae, about 3.5 times the size of Freddie Mac. It is the principal government-sponsored enterprise. So when you see a conventional home mortgage interest rate advertised at a bank or a broker anywhere online, 9 times out of 10 they are advertising the Fannie Mae rate because they tend to have the best conventional rates out there. Freddie Mac, however, does specialize in some other loan products. We'll talk a little bit about self-employed people in a little while here and get back to Freddie Mac. But again, Fannie Mae, Freddie Mac are the main conventional government-sponsored entities that securitize conventional loans. Over the recent 5 years especially, we've seen specialty niche products get developed from these companies for first-time home buyers. On the Fannie Mae side, it's called Home Ready program, and on the Freddie Mac side, it's called the Home Path program. And so these are low down payment, first-time home buyer programs. They tend to be geared towards higher credit, better credit individuals because the mortgage insurance, because it's a private mortgage, is risk-based price. So the better your credit score, the better mortgage insurance you're going to receive. Whereas, again, the FHA program is standard for everybody. Everybody pays the same 1.75% funding fee on the loan, and they pay what's called the 85 basis points monthly mortgage insurance as well, regardless of credit score, regardless of where you are as a borrower. Everybody pays the same rate on FHA. So for the higher credit geared borrowers, I tend to be recommending conventional products more. But the FHA program is the most open box of credit underwriting guidelines out there right now.
And that brings me to my next question. With VA loans, one thing that I do know is you don't need to have a down payment.
That's correct.
But with pretty much all programs out there now, since the mortgage crisis, some sort of down payment is required. So would you be able to give the listeners like some idea of what kind of monetary investment they'll have to count on having?
A minimum contribution, should be expected. I mean, I think no one should expect to be buying a house with $0 out of their pocket. That's not, I think by and large good for the industry. We refer to it as skin in the game a lot of times. The more skin in the game down payment people tend to have, the less they default on a home. But it's not necessarily required, and doesn't mean that you're not going to be a good borrower or a good customer for a lender. It's all about mitigating risk. So let's take the FHA program again. The FHA program, because of the way it's set up, is fully backed by the federal government. So the mortgage insurance that you're paying into that program, sufficient, makes that program self-sufficient and can back losses. Same thing with private mortgage insurance on the conventional side. The only definitive program that is out there, besides those two, is also a USDA rural government development loan. Those are limited in geographic areas. Here in Chatham County, there's very few places inside of Chatham County that qualify. But if you go the next county over to Bryan County or to Effingham County, you can qualify countywide for those, and those have little down payments, have zero down payment requirements as well. Veterans loans have always been no down payment required. This goes back to the first GI Bills after World War II in the 40s and 50s. And a lot of people wanted to be able to reward our military veterans. So I don't see that going away as well. But traditionally, people think of having to be able to put, a large chunk of money down in order to be able to qualify for a house, and that's just not the case anymore in the modern mortgage industry. We're looking for stability. We're looking for credit history, and we're looking for debt-to-income ratio. And we could talk a little bit about that in a minute, if you like.
That's really good information. I didn't know that you could actually go to a different county and qualify for different loans.
That's correct.
So it's something good I didn't know that. New to all of this as well. So let's talk about what you need to qualify for a loan. I mean, if there's somebody that wants to get a loan today, what is it that they would need? And I'm specifically gearing my question towards a lot of my listeners are investors or new investors, and so a lot of them are self-employed like myself. So I'm actually personally having a hard time getting a loan because my tax return doesn't always reflect how much money actually is coming in because I have a lot of expenses with my real estate.
So this is a very common question in the mortgage world. I want to kind of differentiate two groups of people that we're talking about right now. So you mentioned investors and then self-employed people. So I would actually put those people into two different boxes, right? So just pure investors who are buying and selling real estate on an investment basis fall into a different category than, say, somebody who is self-employed but is trying to buy their next primary purchase, right? So we're going back to the conventional product space a little bit here. Typically, self-employed business owners have to show 2 years worth of tax returns income analysis. Okay, and so you're mentioning how your tax returns don't necessarily show what you're truly earning, and again, that's a lot of the reason because of deductions and the way the tax code has been set up. Recently, we just had federal tax reform passed in D.C. Theoretically, the tax reform bill that has been passed is going to help mitigate some of these issues. What you saw was a lot of deductions minimized or completely taken away. And we have tax rates that have been lowered across the board, and specifically for what's called pass-through income. So a lot of self-employed borrowers, buyers will have entities set up simply to collect income that is being passed through from another business activity. And so that has been particularly lowered on the new tax bill. So I hope to see some, a little less pressure on business owners. But one thing that is a very niche product for me, being able to do both Fannie Mae and Freddie Mac, is that if you are a business owner or self-employed and you've been in business for more than 5 years, this is very key. You have to be able to show proof that you've been in operation for 5 years. Freddie Mac will allow a 1-year tax return analysis for a qualifying income. And that's on both the primary, secondary, and investment basis. So as an investor, you could qualify on just 1 year's tax returns. So let me give a little bit of an example of a client of mine who I've worked with for several years. And so this guy, what he does is about every third tax year, he will intentionally file a higher return. Okay, he will pay the federal government slightly higher
I like this
taxes,
guy already. I'm going to have to sharpen my ears here and listen.
So again, what he's doing is about every second or third year, as he saves up capital to make another investment purchase, he will file what a CPA might call a higher return, meaning he's going to pay more in federal taxes than he might have to. He might be required to by law. But again, what he's doing is he is doing that in order to be able to qualify to borrow more money for his next real estate transaction. And so he's not doing that every single year because, of course, he's not purchasing property every single year. So again, I think it comes to investors. You've got to be very much stable in what you're doing. Real estate should not be your only source of income. You want to be able to show a different income for 1 year and not have to pay the federal government higher taxes every year, but you want to be able to show as much income for the year you're attempting to qualify for that home loan. Again, self-employed business owners for primary purchases, there are a lot of specialized loans out there. This is not on an investment basis, but more on a primary occupancy basis. There are a lot of banks and lenders that will do what is known as a bank statement loan. And so what they would do is take your bank statements for, say, 24 months for a 2-year time, and they would average in all of the deposits over that 2-year period and then divide it by 24 and then use that as a qualifying income number. Typically, these products tend to have higher rates than a 30-year fixed conventional mortgage, but for some real estate investors and some self-employed people, it does make sense to be able to get a loan now and then refinance or pay it off later. And so you see a lot of people that get what's closer to being referred to as hard money loans. And these are just private financiers, private lenders that have capital. But of course, the more private the capital is, the higher the rate they're going to want on the return to be able to deploy that capital.
And typically also higher down payment.
Sure, or absolutely. 30, 40% down. They want to have some good
the
safe
return,
skin.
that's for
right.
sure. Well, this is really interesting, and I have a bunch more questions. I think I finally did figure out my music here, so let's play a song, take a little bit of a break. You're listening to Real Estate Real Talk with Julia M. Spencer, and we will just a moment here. Again, we are one computer short here today, so we have to deal with just one. So bear with me here. We are almost here. Clicking away on the board here. Bear with me, my dear listeners. And hello, Savannah listeners. This is Julia M. Spencer with Real Estate Real Talk. You're listening to WRUULP, Savannah, Georgia, 107.5 FM. WRUU.org. We are Savannah Soundings Community Radio with Global Soul. And before we continue our conversation here with Senior Loan Officer Chuck, I still can't say it right. Feagin. Okay.
Just like Oliver Twist.
So I want to just let you know really quickly, if you enjoy our programming on WRUULP, please support the station with a donation. As an individual, you can give any amount, become a basic station member, or become a serious fan of the station. To check out membership rates and to donate to the station, go to www.wruu.org/individual and select to donate monthly or subscribe to an annual membership. Again, to donate to the station, go to www.wruu.org/individual and select to donate monthly or subscribe to an annual membership. Thank you for listening to and supporting WRUULP. So, Chuck, do you have any more input or any more help or guidance you can give to an investor who's got a difficult time qualifying for a loan,
Sure.
maybe? I mean, something, one of my friends actually is trying to qualify for a loan right now. One of my contractors that have been working in my houses for many years, and he is in that boat. He's actually trying to look for income that qualifies, and a lot of the loan officers and programs out there don't let him qualify for every income that he has on his books. So,
well, I mean, every situation is different. That's one thing to specifically remember. Almost no two loan scenarios are the same. I've always, with investors, there's a very big difference, again, between buying for a primary occupancy purchase and then buying on an investment basis. Another big differentiator is a single-family home versus multiple homes, a multiple residence home, multifamily. Anything that is 2 to 4 units, you can still buy on a residential mortgage basis, and you can even buy as a primary occupancy purchaser and use some of the income that's going to be generated off of the rental units to qualify. Typically, a bank or lender is going to give credit for 75% of the fair market rental, long-term rental value for each unit. So let's say that your friend finds a 4-unit home. It's a quadplex, in Midtown Savannah, and he wants to live in one unit and going to rent out the other 3. Well, the other 3 units might be renting for $1,500 a month. You might be 2-bedroom, 1 bath.
Easily.
It could be 50. So they're going to get credit for $3,000 of rental income on the calculation for qualifying, simply because they're purchasing a home that already has rental income built in. If he was going to buy it on an investment purchase, he would get credit for $4,000 because of all 4 units, because he's not going to be living in one of those. So that's one way to help mitigate some of the investor problems towards qualifying for a loan, is to buy a multifamily property that has rental income built in. And then another major thing is to, again, like I intimated before, is to kind of work like one of my clients works and plan to show a higher taxable income for 1 year so that they can qualify for that home loan and then go back to filing their regular filings the other years.
That's excellent information. I never even thought about that. That's just to buying multiple unit houses is much better way.
Absolutely. And just on the tax return and on the income thing, I mean, for everybody who works a job, they're the salaried employee, there are 2 ways to document that income. We get W-2s and pay stubs, and we get what's called a VOE, a verification of employment worksheet filled out by their employer. Well, when you're self-employed, your only verifications for income for us are what you file taxes on, and so it's, there's no company that we can send something to. You are the company.
Yep.
And so again, it goes back to planning and being able to file a 1 year, and this is for people who've been in business for more than 5 years, but being able to show a higher taxable income for 1 year to qualify as a business owner, and that is on that Freddie Mac conventional home loan program.
Good stuff. That's good information. Yeah, Savannah listeners, if you have any more questions about this, feel free to send me an email, realestate@juliamspencer.com. I'm also going to let Chuck talk about how you can reach him directly as well. And I have one more question, which is probably a really good, well, actually I have several more. We can talk all day long, actually. We might have to bring you back in again.
We might have to do a second segment here.
Second segment, yeah, that's right. So would you, give like a basic over? I mean, the whole entire loan process is just so complicated for a lot of people. Would you be able to just talk really briefly about the steps of what happens first, what a home buyer might be expected to have available and to bring?
That's right.
And I mean, I went through this process several times in my life, and I had assistance, but it's been many
Each
years.
time is probably different too.
It's definitely
going to be different today than say 10 or 20 years ago specifically.
And it always seemed to me whenever I did it, I thought I was done, and there's yet another thing.
I got to ask for another thing.
Got me again.
The best way that I like to describe mortgage processing is it's like a three-legged stool. Okay, it's a tripod.
I love that.
One of the legs is your assets, how much money you're putting down, how much money do you have saved up. One major leg is credit history, your FICO scores, and then the third and probably most important leg is your debt-to-income ratio. And so I'm going to talk a little bit about all three. In terms of documentation, we call it the old 2, 2, and 2. Of what you can be expected to have to qualify for a loan. And so when we say 2, 2, and 2, we mean 2 years of financials. So that's 2 years of tax returns, 2 years of W-2s, 1099s if you're self-employed, retirement statements if you're retired, 2 years of those. And then we have 2 pay stubs usually if you're working. That's usually 30 days or 1 month of pay stubs. And then 2 months of asset statements. This would be your checking account, your savings account, any stock trading or investment accounts, retirement accounts like your 401k. We want to have 2 months of those. Those typically satisfy the basic documentation requirements for a mortgage. Now, going back to those 3 legs, okay? You know, when you look at a bar stool or like a tripod for a camera, if you damage one leg, more than likely it's still going to stand up. Right? You know, it might be a little rickety. You might be rocking back and forth on 2 legs, but typically it's going to still stand. If a leg is completely broken and shattered, typically it's going to fall over. So, you know, a customer or client might have, you know, below average credit, but strong enough to qualify, but they have a lot of money to put down and they make a good amount of money and they're a very low debt to income ratio. That's a deal that's going to fly through every time. It's the same thing, you know, a strong credit borrower has perfect immaculate credit, never missed a payment in their life, but, you know, they have 2 car payments, they got some student loans. You know, they look a little bit leveraged, but if they can show very good payment history, good job stability, a lot of times those debt-to-income ratios will open up for them to be able to still purchase despite having, you know, carrying a load of debt on them. So that third leg, one of the most confusing and probably gut-wrenching parts of qualifying is that debt-to-income ratio. So what is DTI? Debt-to-income ratio is your total gross monthly debt payments, including the new mortgage that you're attempting to take out, divided by your gross monthly income. So typically we're looking for somewhere in the 40%, 43, 45% range for a total debt-to-income ratio. So let's say that you made $5,000 a month. You know, as your, you know, pretty much your total gross monthly income, we're going to times, say, 45% of that number. So that's 450 times 5. So we're right at, you know, 2250. And that number of 2250 needs to be able to support the new mortgage payment in total, principal, interest, taxes, and insurance, and all of your current obligated credit payments. Okay. What I mean by that is your car payments, student loans, credit cards, store cards, anything you've co-signed on that would pull up on your credit report today. We're looking to make sure that 43% of your gross monthly income can support all of those debts. So a lot of times what I'm doing with clients, when I say I'm finding that path of least resistance, sometimes clients may come into a purchase time, a transaction with the mindset that they are going to put as much down on the mortgage as possible. They want to, you know, they're going to put 20% down, but they don't even qualify because they're carrying X, Y, and Z in debt load. So sometimes it makes more sense to put less down on the mortgage and pay off other consumer debt, things like credit cards, Most people are paying between 10 and 20% interest on their credit cards. Well, why would you put another 20% down on your mortgage, which is going to be a 3.5%, 4.5%, maybe 5% rate as an investor even? Why would you put more down to pay a less rate and then pay off the higher rate consumer debt? So a lot of what I'm looking for is to really find the why behind the why. Every transaction's kind of got a couple of levels of why they're doing this. Everybody wants to buy a house in their life. Everybody wants to have a good place to live, a good neighborhood, a good school system for their kids to go to. But a lot of times there is a little bit deeper of a why behind a consumer's decision. And the quicker that I can get to that and get to the real story, the easier it is for me to guide those clients on that path of least resistance towards closing on their own.
That's awesome. Well, it looks like you definitely have your client's best interest in mind.
Well, I appreciate that. I really do. If people want to get in contact with me, I'm, of course, on Facebook as well. Chuck Feagin, NMLS ID 884138 on Facebook. And then my website is very easy to remember. It's www.lendwithchuck.us, because I do lend all over the country. That's, again, www.lendwithchuck.us. And I look forward to helping all of our listeners, attain home ownership and guide them through what can sometimes feel like a nerve-wracking process.
Yes, for sure. Well, thank you so much for coming into the show.
Pleasure.
Appreciate it. Again, you are listening to WRUULP, Savannah, Georgia, 107.5 FM, WRUU.org. We are Savannah Sounding's community radio with Global Soul. Thank you so much for listening to my show here, Real Estate Real Talk. My show is on at noon on Wednesdays, middle of the day, middle of the week, easy to remember. Now, just a couple of points of info before I sign off for the day. You can reach me at realestate@juliamspencer.com. I always tell people, don't forget the M in the middle stands for money. And I'll also be sitting in a special show way left of the dial on Monday, this coming Monday from 4 to 6 p.m., January 29th. We'll have a special guest and musician in the studio who will be showcasing some of his songs. And also a little bit of a shout out to my son Julian, who is in bed sick, unfortunately, today. He's listening, hopefully, on the radio. And with that, I'll be signing off. We'll be back again next week on Wednesday at the same time. So don't miss my show again. And hopefully you have a great rest of the week. And send me any feedback or questions that you may have about the show. Have a great rest of the week. Thank you.
For your free guide to real estate investing, visit juliamspencer.com.